10 smart financial tips to increase your savings. Meet Lucy. Like many of us, Lucy works hard, pays her bills, and dreams of having a little extra in her savings account. But every month, it seems like the money disappears faster than it comes in. One day, Lucy had enough. She decided to take control of her finances and start saving more. Here's how she did it. 1. Track your expenses. Lucy began by tracking every dollar she spent. For a month, she diligently recorded her expenses using a simple app on her phone. This helped her see exactly where her money was going. Example, Lucy discovered she was spending $3 every day on coffee. That's $15 a week and $60 a month. Seeing these numbers helped her realize her spending habits. Additionally, she noticed that she spent a significant amount on dining out, which she could cut back on without drastically changing her lifestyle. Detailed step to track your expenses effectively. Start by categorizing your spending. Common categories include groceries, dining out, transportation, entertainment, utilities, rent, and miscellaneous expenses. By breaking down your spending into these categories, you can easily identify areas where you can cut back. Use budgeting apps like Mint or Yinab. You need a budget to automate this process and provide insightful visualizations of your spending habits. 2. Set savings goals. To stay motivated, Lucy set a goal to save $1,200 in a year for vacations. That meant setting aside $100 each month. Having a clear, tangible goal made it easier for her to resist unnecessary spending and prioritize saving. For example, with this clear goal in mind, Lucy could picture herself on a relaxing beach vacation. This visualization helped her stay focused and motivated to save. Detailed step when setting savings goals, it's crucial to make them smart, specific, measurable, achievable, relevant, time-bound. For example, instead of a vague goal like save more money, set a specific goal like save $5,000 in a year for an emergency fund. Break down this goal into smaller, manageable monthly or weekly targets. This approach not only keeps you motivated but also makes the goal seem less overwhelming. 3. Apply the 50-30-20 rule. Lucy learned about the 50-30-20 rule, which divides after-tax income into 3 categories: 50% for needs, 30% for wants, and 20% for savings and debt repayment. She decided to give it a try and found it to be a practical way to manage her finances. For example, with a monthly take-home pay of $3,000, Lucy allocated $1,500 for essentials like rent, groceries and utilities, $900 for discretionary spending like dining out and entertainment, and $600 for savings and debt repayment. Detailed step to implement the 50-30-20 rule. Start by calculating your monthly after-tax income. Next, determine your fixed expenses needs such as rent, mortgage, utilities, groceries, transportation, and insurance. Then allocate 30% of your income to discretionary spending wants such as dining out, hobbies, and vacations. Finally, allocate 20% of your income to savings and debt repayment. This simple formula provides a balanced approach to budgeting, ensuring that you're saving for the future while enjoying your present. 4. Create an emergency fund. Lucy understood the importance of having a financial safety net. She aimed to save enough to cover 3 to 6 months of living expenses, starting with small monthly contributions. This fund would protect her from unexpected expenses or income disruptions. For example, with monthly expenses totaling $2,000, Lucy aimed to save between $6,000 and $12,000. She opened a dedicated savings account for emergencies, ensuring that this money was not easily accessible for everyday spending. Detailed step to build an emergency fund. Start by calculating your average monthly expenses, including rent, utilities, groceries, transportation, and any other necessary costs. Aim to save 3 to 6 times this amount. If this goal seems daunting, start small. Set up automatic transfers from your checking account to a high-yield savings account specifically for your emergency fund. Consistency is key, so even small monthly contributions will add up over time. Additionally, look for ways to boost your savings, such as directing any windfalls like tax refunds or bonuses directly into your emergency fund. 5. Automate your savings. To make saving effortless, Lucy set up automatic transfers to her savings account. Each payday, $200 was automatically deposited. This ensured she saved consistently without having to think about it. This simple step ensured Lucy saved consistently without the temptation to spend that money elsewhere. Automation took the decision-making out of the process, making saving a habit rather than a chore. Detailed step to automate your savings: set up a recurring transfer from your checking account to your savings account. Choose a fixed amount that fits your budget and schedule the transfer for each payday. This way, you prioritize savings before spending. If your employer offers direct deposit, see if you can split your paycheck into multiple accounts, automatically directing a portion to savings. Additionally, consider automating your contributions to retirement accounts, such as a 401k or IRA, to ensure you're saving for the long term as well. 6. Minimize unnecessary subscriptions. Lucy reviewed her subscriptions and cancelled those she no longer used. She realized she had 3 streaming services but only regularly used one. Example, by eliminating unnecessary subscriptions, Lucy saved $25 per month, totaling $300 annually. This was a straightforward way to reduce her spending without sacrificing much. Detailed step: conduct a subscription audit by listing all your current subscriptions, including streaming services, gym memberships, magazines, and apps. Assess which ones you use regularly and which ones you can live without. Consider using a service like Trim or Truebill to identify and cancel unused subscriptions for you. Additionally, look for ways to share or bundle subscriptions with family or friends to reduce costs further. Regularly review your subscriptions every few months to ensure you're not paying for services you no longer use. 7. Plan your meals. Lucy realized she spent a lot on takeout. She started planning her meals for the week and making a shopping list. This not only saved money but also led to healthier eating habits. Example, by cooking at home and limiting takeout to once a week, Lucy saved $30 to $40 weekly, up to $160 monthly. Meal planning helped her stick to a budget and avoid the temptation of last-minute dining out. Detailed step to plan your meals effectively: start by setting a weekly menu. Choose recipes that are easy to prepare and use ingredients you already have or can buy in bulk. Make a detailed shopping list based on your meal plan and stick to it while grocery shopping to avoid impulse purchases. Batch cooking and meal prepping on weekends can save time and ensure you have healthy meals ready throughout the week. Additionally, consider incorporating more affordable and nutritious ingredients like beans, lentils, and seasonal vegetables into your meals. 8. Buy in bulk. Lucy began buying non-perishable items in bulk, such as toilet paper, rice, and canned goods. This approach often meant lower costs per unit and fewer trips to the store. Example, purchasing a 24-pack of toilet paper for $20 instead of single rolls at $1 each saved Lucy money over time. Bulk buying non-perishable items allowed her to take advantage of lower prices and sales. Detailed step: identify non-perishable and frequently used items in your household that you can buy in bulk, such as toiletries, cleaning supplies, grains, and canned goods. Compare unit prices to ensure you're getting the best deal. Warehouse clubs like Costco or Sam's Club often offer significant savings on bulk purchases. However, be mindful of storage space and only buy what you can reasonably use before the items expire. Additionally, consider joining a bulk buying group with friends or family to share costs and benefits. 9. Avoid impulse buying. Lucy made a rule to wait 24 hours before buying non-essential items. This helped her curb impulse purchases and save money. Example, delaying a $50 shirt purchase allowed Lucy to reconsider, realizing she didn't need it and saving $50. This simple rule prevented many unnecessary purchases. Detailed step: implement a cooling-off period for non-essential purchases. If you find something you want to buy, wait 24 hours before making the purchase. This gives you time to assess whether you truly need the item or if it's an impulse buy. For larger purchases, extend the waiting period to a week or even a month. Use wish lists to keep track of items you're considering and revisit them periodically to see if you still want or need those items. Additionally, unsubscribe from marketing emails and avoid browsing online stores to reduce the temptation to buy impulsively. 10. Review and adjust your budget regularly. Lucy knew financial situations change. She regularly reviewed her budget and made adjustments as needed. This practice helped her stay on track and adapt to any changes in her income or expenses. Example, when Lucy received a raise, she increased her savings contributions and debt payments. When expenses rose unexpectedly, she found areas to cut back without sacrificing her financial goals. Detailed steps: set aside time each month to review your budget and assess your financial progress. Compare your actual spending to your budgeted amounts and identify any discrepancies. Adjust your budget as needed to reflect changes in your income, expenses, or financial goals. Use budgeting tools and apps to simplify this process and provide detailed insights. Additionally, set annual financial goals and review them regularly to ensure you're on track. This proactive approach helps you stay in control of your finances and make informed decisions. Conclusion: Lucy's experience shows that managing money doesn't have to be daunting. By tracking spending, setting clear goals, and following these practical tips, she increased her savings and achieved financial stability. You can do it too. Start small, stay consistent, and watch your savings grow.